I spent a long time looking at what is the predominant driver of price of crypto, and I came up with the fact that it's the amount of volume kind of multiplied by the number of wallets. And that is a good fit for pretty much everything, number of active wallets. So we need, for the price to increase, we either need daily volumes to increase or the number of active addresses to increase. Right now, we've got neither. So we got to think, okay, how will we drive that? We either do it from further retail participation, but in an inflationary environment where real wages are negative, it's difficult. So therefore, it would have to be institutional. Now, as I've said to you on the show before, I spent all day speaking to institutions, and pretty much everybody is they went last year to get approvals. They've now started getting approvals. They're now trying to figure out how the hell to do it. And so don't forget, 32 billion last year went into VC because they couldn't put it on their balance sheets, and it's easy to do VC. So that tells you there's pent-up demand from institutions, but the reality is they just don't want to own Bitcoin on their balance sheet. One of the things I've done on the side is built a fund of funds business that invests in crypto hedge funds, because you need institutional product right now. There's no institutional product. They're not going to use the ETFs because they're all futures based. But if you're an institution, it's very difficult to describe to your investment committee why you own something that says Bitcoin on it and it's diverged in price. These kind of futures-based products tend to be retail only. All these triple levered, all of these other things that we see in commodity markets as well, they're the same. Well, the problem is Bitcoin, unlike gold, has two qualities. One is the store of value quality, and the other is the growth quality. What can the network be used for, the new technology, and those things are always interplaying. So this is why you see this kind of schizophrenic nature of Bitcoin and crypto overall. Is it shifts narrative, so it's not correlated all the time. So we have passing correlations as opposed to total correlations. So over a longer time period, I wrote a tweet about this, over a longer time period, there is very little correlation over anything. Over short-term correlations, over short-term time periods, you've got correlations with all sorts of things. 2020 is not a good example because it was a 2-month recession and it was met by the largest stimulus the world has ever seen. So you need to go back and look at 2008 and 2001-2 and look at how long a bear market lasts if there's a recession and how deep it was. In those cases, they're generally 50% downside and they tend to be 18 months long. So we don't know where we really are in this situation. Don't forget, the reaction function of central banks has changed now. So they tend to be faster on the trigger, but this one's different because we've got high inflation. So there's a lot of unknowns for all of us in this. We don't know their reaction function well enough yet.
But all the other times that you've mentioned are times where there have been catastrophic breakdowns in the system. So you're talking about 2008 catastrophic breakdown in the system.
That's what recessions lead to. That's not what causes the recession.
Okay.
Right? So what happens when growth contracts and the price of collateral falls or leverage contracts, it exposes the weakest hands. So that's why we saw those situations. If we had a full recession now, what would be the thing that blew up? Probably nothing. And the reason being is the central banks don't want the collateral to go bust because leverage is too high. So we saw them already in 2020 buying credit. That was them saying we can't allow that to go bust, even though a healthy cycle is weak borrowers should go bust, but they can't allow it. It's too much leverage. So it's a really different world. Well, one of the things that I think people haven't talked about is this rise in prices is a massive tightening of monetary conditions. From my expectation, I think we've already hit 200 basis points, and that's why the yield curve is essentially zero. So the ability of the Federal Reserve to raise rates without a recession is pretty close to zero. So therefore, if a recession or something close to it is already being priced in by the yield curve, then demand should come down anyway. So I'm actually less of an inflationist over time. I think more of the inflation argument, or more of the inflation was driven by the supply as the world came back online again and there was restricted supply. So I don't think the Federal Reserve could have done a lot differently. I think you would have taken some of the inflation out for sure. It's looking at the macro environment. The macro environment is not easy to trade either. you kind of, being short in this environment in equities, how much further downside? Well, if you go back to every tightening phase from the Federal Reserve, the market tends to sell off about between 15 and 28%. And we're kind of in that zone. So should it go any further? If we're in a full recession, then it's different. But we also have the reaction function from central banks when we get into recession, is they're going to use the balance sheet. Now, we might see direct transfer payments, i.e., tax rebates or whatever version to offset the energy costs and the inflation costs. Well, that's actually a net printing of money, and I think that's a positive for the market that's likely to come. The macro markets are actually quite difficult to trade right now. The dollar feels like it's going higher, but I think it's not going to be in a straight line. Bond yields, I think, will probably top out somewhere between here and 225 in the 10-year bonds, but we're kind of still a bit in no man's land. We sold off, didn't really stick in terms of yields. It's not an easy place, but I'm trying to sit patiently. I'm long a bit of bonds, long a bit of gold, and long crypto, and long some dollars, and just kind of waiting to see. I don't think it's the time to take aggressive bets yet. So you need to figure out in game theory who's trying to get the advantage over whom. I don't think much of what's happened will have been a shock to anybody involved, in terms of, the Russians kind of would have expected this, and everybody's trying to push it for their advantage. Maybe the advantage is to weaken Europe as a whole, or NATO as a whole. Maybe the US has an advantage now that it can become the predominant energy player by pushing Russia out of the market. These games are ugly in geopolitics. If you ever read the book, The Confessions of an Economic Hitman, I got about 2/3 of the way through it and I put it down. I thought, I don't want to know this stuff. It's so ugly that it's just not nice, and you'd rather not be involved. And the other thing is none of us know. So it's just conjecture. We can sit here all day and pretend we know, but we don't. Mine haven't changed at all. I haven't taken a penny out. The riskier end of the curve, I had thematic strategies. So I had DeFi, I had some metaverse, some layer ones, but mainly, it's 80% ETH. The riskier end of the curve got killed. Some of the metaverse stocks did pretty well in a bear market for a period of time. It's like, for me, that's fine. And only so, therefore, if I think of the risky side of the market, I took a small amount of risk in that. I then topped up with ETH calls, because that was I thought we had a decent probability chance of an upside break at the back end of last year. Didn't happen. So I haven't expired yet. If ETH gets to about 15,000 by 2 weeks, I'll be in the money. And that's fine for me. So really what I've been doing is looking to allocate more over time slowly, because this is not a market I try and time, because I'm not really interested in that. I'm not a shorter term guy. So I'm looking where to allocate and how to allocate. I'm still struggling to find a better bet than ETH as a risk adjusted reward over, give it a 12-month time horizon. Yes, others will do better, but you got the changes to ETH coming. That's all coming by the summer. I think also we're going to get the Bitcoin ETF, the spot one out. From what I'm hearing through back channels, that there's at least 2, maybe 3 that are going to get approved, and that's April. So now that doesn't mean that people rush into that, because Bitcoin's going down. So why would they? But at the margin, these are positive news flows.
So you're thinking, or your back sources, let's not call them back sources, but you're thinking that there may be a Bitcoin ETF as soon as April, a physical Bitcoin ETF.
Yeah, April, May. But April there's at least 2 in April, with Bitwise and another one. We're getting very close. And, Gensler's statement this week or last week, whenever it was, I've lost track, was very positive for this kind of stuff, which is, we get it, it's here, it's not going away, we'll regulate it carefully. It's just all the right steps.